Today we're at an inflection point. When you see what's happening with the debt, when you look at what the Federal Reserve is going to do and actually compare that to the data that we have, I'm going to bring you all that today and you'll realize why this is so serious and can be a problem for so many people. I wanted to begin by first looking at the dollar itself. So it has strengthened here. Why has that been the case? We have looked at a little bit of a change in tone coming out of the Federal Reserve and some other central bankers. Dollar is close to erasing 2023 losses on further US hike bets. Greenback seen the longest weekly winning run since September. Two Fed officials favor returning to bigger rate hikes. I'll show you that in just a second. The Bloomberg Dollar Spot Index is now poised for its third weekly gain, the longest since September. Real money has brought the currency this week, mainly against the euro and the yen. So of course, these things, they're always against each other. They are floating against each other, and you're never going to be able to know how real this all is, because one could be going down severely and then of course, oh, well, that one looks better. But it's important to see what it buys you. What does your currency, if it's the US dollar, buy you? For people that are in a country that, you just look at a year after year after year, not just a short term, but longer term, if the US dollar is generally strengthening against your currency, it is imperative that you find a way to earn US dollars, even a small percentage of your income. That can make a huge difference for some people. If people were doing that in Lebanon, if people were doing that in Argentina and other places, they would probably be much better off today, even if it was a small piece. That's the thing you got to do, and you can do that online by having a product or service that is in demand in different places that you might not be. Okay, that's one thing. We look at what's happening with the Fed's master. She says that she saw a compelling case for a half-point rate hike. Of course, looking at the jobs, there's unlimited amount of jobs out there apparently. And then you could see what's happening with just focusing on the empty jobs, the unemployment rate. Those are two factors right there. At the same time, you can see that largely the markets are doing very well. I mean, it shouldn't be a secret to anybody. The S&P 500 is over 4,000 right now. It peaked out not even at 5,000. So there's really no concern for a lot of this to increase beyond where they are today. Fed's bullard open to a half-point rate hike at the next meeting. We don't know. We don't know what's going to happen here, and a lot of them have priced in sort of that 5% to 5.4. That's been the range. Still not enough as far as I'm concerned, but that's what they're suggesting, and we don't know how far they'll go. Many people had said that they would not even hike at the next meeting. I believe that they will hike, and it will be a 25 basis point hike. I've been accurate on that so far. And why? Because they really made it pretty clear in what they say before they do it. I don't know why there's any surprises. There really never is. This is the Fed's terminal rate, so where they expect rates to go. But that really is all about market expectations. So you got to understand this. If the market believes that it's going to be 5.3%, and it gets to, let's say, 5.2, the market reacts positively. If it would be 5.5, let's say, the market reacts negatively. So it's always based on expectations, just like the jobs numbers, just like inflation data, like all these things are based on the expectations. They already price it in when it relates to that expectation. At the same time, they're expecting rate cuts. That's the funny thing. They are also going to go through and, make this claim that in the same year they're increasing, they're cutting. Like it just doesn't jive, okay? It really doesn't. And that's why for a lot of people, they're confused. They're investing anyway, and they're doing dollar cost averaging. Now, I want to show you the greatest chart, the absolute greatest chart in just a second. Let me show you this first. It's been tough out there for investors. Even playing it safe hasn't been enough. Retail investors were down an average of 30% in 2022, resulting in $350 billion in losses. The average 60/40 portfolio lost 25% adjusted for inflation in 2022. As a result, there's been a lot of interest in alternative assets by some of the biggest players in finance. Institutions already allocate 30 to 50% of their assets to alternatives, and now Masterworks is bringing alternative investments to the retail investor. Goldman Sachs specifically names fine art as a way to help protect purchasing power. Masterworks lets you invest in multi-million-dollar art without needing millions of dollars. With over 630,000 users and $650 million in assets under management, Masterworks breaks down physical paintings from legends like Picasso and Banksy into shares through the process of securitization. When a painting you are invested in is sold, you get a slice of the potential return. Last year was the highest total ever for auction houses with $17.7 billion in sales. With 9 exits in 2022, returning $25.8 million to investors, it's no wonder that demand for Masterworks is high and offerings have sold out in minutes. But don't worry, the link in the description skips you ahead of the wait list so that you can invest right away. And here is that chart. This is, of course, what I call the money mirror method. And like I said, I will be doing a video. I'm just trying to get as much data for it as possible. I really want to make it good. This is comparing the US, basically the Federal Reserve's balance sheet, okay, compared to what you can see with the stock market, okay? Stock market to balance sheet. Comparing the two of those, going back from 2020 up until the present, and you could do this from 2009, and it basically always shows the same thing. They mirror each other. They're going, ups and downs, variances along the way, bumps in the road, but they generally move in the same direction. Whenever there's a decoupling in between these two, it tends to fall back. And even though people say, no, it's impossible, this is impossible. No, can't happen. Well, we do see that. And, look at the US market cap, that blue line. Back in 2022, it was going straight up and up and up, and everyone said that was it. The bear market's over. And what happened? Well, it turned around and it got pretty bad up in the fourth quarter. Then it came back, then it went down. It's been bouncing around here. So we are at that decoupling stage right now. So the expectation for anybody watching this is that the markets could go sideways for a period. They can go down. The balance sheet can go up, but ultimately one of those has to occur. Now, what can you take from that? It's that you have to monitor this closely. You can monitor this. I'll give more details about that in that money mirror method video. But essentially, you have to know what's happening with the balance sheet. That's what I'm going to say. You watch the balance sheet. That's when you know that you need to be investing. Dollar cost averaging is not a strategy, and I'm not sure why any sensible person would tell you to do that, other than the fact that it's kind of easy, right? Like it's safe. Oh, I'll just tell them to dollar cost average because, that way they can't get upset at me and, over the long term, it's a great strategy. No, depends. That's actually not really true. Debt-driven consumption. Look at it. Just look at it for yourself. Consumption as a percentage of the GDP, it is above 68% at this time. You realize, think about it. You are going to have a consumption-based economy largely. That's great when everybody's consuming. But what happens when they've maxed out their debt? They're right up, they're right up to here. They're sinking. Okay, they're just sinking right now. And what does that bring you when you're basically trying to bring the future to the present with debt? That's what you're doing. Oh, I don't have enough money for this, so I'm going to use debt, bring that future into the present. And people do that with their houses. People do that with their vehicles. People even do that with a ham sandwich nowadays. But for a lot of people, this is basically taking the future, bring it to the present. And if you are responsible, and if you have a 20% down on the mortgage, you pay that diligently, and maybe that payment was, let's say, $1,000, but you really have $10,000, well, then that's a great buffer in there. You're doing it safe and sound. But for a lot of people, they are, what can I qualify for? Okay, that's what I'm going to get. And that shouldn't be like that. I'm not saying that you got to live like way beneath your means. You got to, live on the streets when you got money. No, but you have to be responsible about it because it doesn't end well otherwise. The Federal Reserve and the financial crisis, I just want to show you here that black line is representative of the Fed funds rate. And just note where the dotted vertical lines are. Every single time they do a rate rise, you get a recession. Sometimes they're more mild, sometimes they're more aggressive. But ultimately, it's the same thing every time. Every single time. And people don't realize that pattern. I don't know why. It's pretty obvious. And then they bring it down to zero. So we can expect again that the Federal Reserve will at some point bring rates down into zero at the same time. They will bring them into I shouldn't say at the same time, but we consider the possibility of them bringing it into the negative. So I would be very concerned about that because it really ultimately means a destruction of your currency. You want to see stronger rates. The dollar's doing well, right? But what happens if the dollar becomes extremely weak and some other countries basically say, no, we're not playing these games anymore? Well, it all depends. The Federal Reserve is kind of trusted on a global scale, and other currencies are weakening themselves too. It's not just one currency being devalued. That's what's giving the Federal Reserve its edge. It's, hey, everybody's doing it, so we don't look as bad. Consumers failing to make ends meet. And I just want to show you this. This is consumer credit per capita. That's the black line that's increasing there. The green area is the gap between the real disposable personal income and the cost of living. So essentially all it's trying to show you here is that as time goes on, people take on more debt. They don't have the income to support their spending habits. And that might be spending habits on food, energy, housing. It may not be anything fancy, but that's the way it goes. This is the leading economic indicators. And what that is like a whole bunch of things, like 30 different things that include inflation, it includes the jobs numbers, it includes like all these bunch of things. They put that together and essentially gives you an idea of what's going to happen with the economy. That's the GDP, that's the gray line there. And that has come down. Both of them together are starting to decline. The growth is going away, and this generally suggests that we are headed towards an official recession, perhaps this year. But again, they'll decide when they want to call it a recession, if they want to call it a recession. So they are right now seeing, including the leading economic indicators, we're getting to that point right now where we're at a recession signal. So this is just telling us that we could be officially, and that would, if it's, if you start seeing the labels out there, recession, that makes businesses scared. That starts to create a sense of difficulty in these companies. They might start laying off more people. We go from, okay, just laying off, a bunch of people in this department and that department. Now they go wide scale. And we can see that all throughout. Financial companies are doing it, tech companies are doing it, and just about everything. We see that starting to occur because they're anticipating a recession. So all of this right here, watch very closely to what happens with the balance sheet. Look at the interest rates of your central bank, wherever you are, and pay attention very carefully to how businesses are responding to that data. There's my summary for you. I hope you appreciated this information. Very important stuff. Watch where your assets are. Always make sure that you are taking care of it. Watch them very carefully because 2023 is not what we saw in the years prior, okay? These past couple of years, some funny stuff has been going on. If you appreciated this message, you definitely want to hit that like button down below, and I will see you tomorrow. Take care.